This is April. She's about to do her taxes for the first time, and she's wondering how all of this really works. First, April will add up all of her income. There are many types of income, but the most common ones are wages earned from a job, interest and dividends earned on bank accounts, alimony received, distributions from retirement accounts, unemployment compensation, and any taxable part of Social Security earnings. It also includes cash you received for work, whether or not you got any paperwork from the person who paid you. April just has one job where she earned $40,000, and she also had $50 in interest from a savings account. April's total income is $40,050. Next, she gets to subtract any adjustments to income. This includes things like contributions to an IRA, alimony that you paid, or student loan interest that you paid. April contributed $4,000 to an IRA, so she gets to subtract that from her total income as an adjustment. Her adjusted gross income is $36,050. Next, she gets to subtract either the standard deduction or itemized deductions. April doesn't have enough to itemize her deductions, so she'll take the standard deduction she qualifies for, which is $9,350. She also gets to subtract any exemptions she qualifies for. There are two types. You can claim a personal exemption for yourself as long as you're not someone else's dependent. You can also claim an exemption for every person you claim as a dependent on your tax return. April is a single mother, and she supports her daughter, so she gets to claim one personal exemption and one dependent exemption. Each one is worth $4,050, so April gets to subtract $8,100 before continuing. April's taxable income is $18,600. Your tax is a percentage of your taxable income. Applying the tax tables, April's tax turns out to be about $2,324, but that's not necessarily the final number. Once you have determined your tax, you can subtract any credits that you qualify for. Standard or non-refundable credits can be used to decrease your tax to zero, but not less. These credits include things like child tax credit, education credits, or credits for child and dependent care expenses. Since April's tax is $2,324, she could subtract at most that amount of non-refundable credits, even if she qualified for more. April qualifies for $1,000 in child tax credit, and also $200 in dependent care credit. This brings her total tax to $1,124. Finally, April gets to subtract any payments she made. For example, what was withheld from her paycheck, and any refundable credits. Refundable credits are special credits that you can apply even if your total tax is zero. The most common refundable credit is earned income credit. April qualifies for $515 in earned income credit. She also had $1,500 withheld from her paycheck for taxes. That means April will be getting a refund of $891. Whether you're doing taxes by hand or using the latest tax software, make sure you subtract everything you're entitled to.